Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Qingyi. Good evening. Today is Wednesday, November 26th. I'm analyst Zhang Jida, also known as number 3. Please remember to like, subscribe, and share for us. If you have any investment questions, feel free to leave me a comment. If I don't get a chance to answer today, I'll follow up with everyone in tomorrow's class. Of course, today I'll also be answering questions that students asked during yesterday's chat. Alright, first, let's take a look at today's investment highlights. Besides the follow-up explanations on yesterday's flood of data, since the US government has reopened, there are actually a few data releases coming up tonight at 9:30 that I'll walk you through, so make sure to pay special attention to those. Even though tomorrow is the Thanksgiving holiday in the US, there is still a lot of important data releases and events happening today and into the early hours of tomorrow that I'll be analyzing for everyone. Alright, first up, will the ADP report boost the case for interest rate cuts? The so-called Santa Claus rally might be on the way. ADP, which we often call the mini non-farm payrolls, is a key indicator. Can this mini non-farm data help strengthen the case for a Fed rate cut? And what kind of signals will it send? I'll be explaining all of this clearly for everyone today. So what about the overall stance of the Federal Reserve officials right now? Inflation and the job market are the 2 main focuses. Most officials currently believe that inflation is not out of control, but they are actually more concerned about signs of weakness in the job market. As for the job market, if it shows relative weakness, that would support the Fed taking more aggressive action to cut interest rates. So what signals did this ADB Small Business and Agricultural report reveal? We'll explain in a moment. Also, Santa Claus is about to be revealed. Who is that? It refers to the next Federal Reserve chairperson. Who will be the next Fed chair? Around Christmas, the nominee should be presented to Trump for announcement. Among May's candidates, a few seem more likely to be chosen. Who are they? What impact could this have on monetary policy, the economy, or the stock market? That's something we need to watch closely. Let me explain this clearly to everyone. In addition, regarding the industry side of things, yesterday, Little Donkey happened to ask again about the story of guns and bows and arrows. Back on January 27th of this year, there was a new software platform called DeepSeek AI that suddenly emerged in China. At one point, it shook up the US and global AI market, especially when Apple and OpenAI launched ChatGPT and caused a huge stir. But when China's DeepSeek appeared, everyone worried the AI industry might be headed for a major crash. At that time, at the end of January, if you still remember, we once talked about a story from Africa about the grasslands. The story of the African grasslands, the story of bows and guns. In fact, aside from OpenAI and DeepSeek, now we have NVIDIA and Google. When it comes to NVIDIA's general-purpose GPUs and Google's ASIC-based TPUs, these 2 types of AI chips are actually closely related to the bows and guns from the African grassland story. How should we look at this? I'll explain it clearly to everyone. In addition, the so-called AA is still going strong, holding the line and propelling things forward. AA refers to Alphabet and Apple. Today, there's also a bit of slightly positive news about Apple. What exactly is this news, and what should we be paying special attention to? Google continues to be very, very strong. So when it comes to the Google camp, and even including the NVIDIA camp, how exactly should we be thinking about these 2 areas? Even though the Hong Kong market will be closed for the holiday tomorrow, everyone should still pay attention to the relevant information. Alright, good night everyone. Just now, when I looked at the previous episode, I saw Hui Huanzhuan and also Mei Daizi. Good evening to you both, as well as Yuwalin Ge, and it seems like Justin Lee, good evening, also Alvin Chan, and who else? Alice Fu, good evening with your sparkling water, and to all the staff, good evening to everyone. Now, let's get started with today's economic data section and give everyone a quick update. First of all, at 9:30, there will be the initial jobless claims and the number of people employed in the livestock and poultry industry. Currently, the previous figure for initial jobless claims is 220,000, and the forecast is 225,000. As for the number of people continuing to claim unemployment benefits, the previous figure was 1.974 million, and the forecast is for it to drop to 1.969 million. Looking at these numbers right now, I think the entire range for initial jobless claims should fall between 200,000 and 230,000. And on average, it should be within that 200,000 to 230,000 range. So if the jobless claims data released later doesn't spike significantly, it means the overall job market is at least just gradually cooling off, but it's not heading toward an economic recession or a collapse. So if it falls within the 200,000 to 230,000 range, then that also means that for now, this situation is still within a controllable range, of course, to some extent. If the initial jobless claims number ends up slightly above 225,000, or even higher than 220,000, then that will also increase the market's expectations for a Fed rate cut in December. Let me say it again. If the data released later, it highlights, look, when you look at the number of initial claims, if it jumps above 225,000 or even above 220,000, just don't let it spike too much. Don't let it shoot all the way up to 270,000 or 280,000. That would be too high. If it's around 230,000 to 240,000, that's still within a controllable range. At that point, people will think that the job market is still relatively weak, so the chances of the Fed cutting rates in December will increase, and of course, that would be a positive for the stock market. So at 9:30, there's also the September durable goods orders month-over-month data. The previous figure was 2.9%, but the forecast is a drop of 0.3%. Of course, a big reason for this is what happened in September. At that time, it should have been August, the previous month, which is August. In August, there were things like aircraft orders and defense orders, so of course the durable goods orders month-over-month figure was pushed up quite a bit. So what about the data for September coming up? Normally, it will come back down as part of the cycle, since there's no boost from orders. If there are fewer orders, it's reasonable to expect it to drop to 0.3. But aside from just looking at this data, sometimes we break it down, like removing defense orders or aircraft orders to compare the actual relevant numbers. Sometimes we use this as a reference. Anyway, at 9:30 we'll track this together. Besides these two data points at 9:30 being relatively important, what else is there? Tonight, there are two data points that haven't been released yet. They could be announced tonight or next time. One is the Chicago Purchasing Managers Index for November in the US, previously 43.8. The expected and actual values aren't known yet. You can just glance over this because over the past 2 to 3 years, actually, the Chicago PMI data has consistently stayed below 40 or 50. Generally, when we say it's below 50, that means that's considered relatively tight. Whoa, and if it's above 50, then it's more on the expansionary side. But looking at it now, actually for the past 3 years, it's been below 50. So you can just use this data as a reference and mainly look at how it changes compared to the previous value. Okay, Melissa, good evening. Another thing, the total number of new home sales in the US for September is also, this data is more related to real estate, so we should view it a bit more neutrally. Its impact on the US stock market will also be relatively limited. The previous value was 800,000 units, and the forecast is 709,000 units. Keep an eye on these 4 data points. Before the Thanksgiving market holiday tomorrow, there are basically just these 2 or 3 data releases to watch. But most importantly, aside from tonight's initial jobless claims and the durable goods orders, I think everyone should also remember something else. At 3 a.m. tomorrow, the Federal Reserve's Beige Book on economic conditions will be released. So, aside from celebrating Thanksgiving, if you happen to be up at 3 a.m. or check it tomorrow, take a look at what the Fed's Beige Book says about the economy. Generally, the Beige Book covers about 4 to 5 main categories, which are, it'll talk about the main 12 regional districts of the Federal Reserve, possibly including changes in consumer spending in these areas, business investment, inflation, economic growth, and even the status of prices, among other things. All of this will be reflected in the Beige Book. So why is the Beige Book so important? It's because the Federal Reserve often refers to the most recent Beige Book before their meetings. They use it to determine, at this stage, whether inflation in these 12 key regions has cooled down, what the job market looks like, how household and consumer spending are changing, and what the saving situation of the people is, among other factors. This helps them deduce whether, in the upcoming Federal Reserve interest rate decision, monetary policy should move toward easing or remain unchanged. That's why, before the interest rate decision, we often tell everyone that the Beige Book is very important. This is the reason. So, this report will be released at 3 a.m. tomorrow. Everyone, you might want to pay close attention to this. Alright, now let's talk about the ADP part. Good evening, 950, and also Yi, I love Jolin, 2502, good night, good night. Besides that, the ADP report, which we often call the mini non-farm payrolls, is actually released by a private organization. Generally speaking, the ADP report, or mini non-farm payrolls, is usually released on the first Wednesday of each month. The official non-farm payrolls, published by the US Department of Labor, typically come out on the first Friday of each month. However, due to the US government shutdown, the official non-farm payroll and unemployment rate figures haven't been released for the past few times. But as for the ADP report, aside from its regular release on the first Wednesday of every month, now it has also changed to releasing weekly data every Tuesday. The most recent report, which covers up to November 8th, stated that in the 4 weeks leading up to November 8th, the average weekly decrease in employment in the US private sector was about 13,500 people. So to put it simply, if you have an average decrease of 13,500 people per week, and there are about 4 weeks in a month, you just multiply 13,500 by 4. So roughly estimating, the number of jobs this month may decrease by about 50,000. So it's roughly 40 to 50,000 people, that's the general idea, between 40 and 50,000. For the current situation, last month's ADP data for October showed an increase of about 42,000. So this time, if we assume the data for November, if we assume the monthly ADP data if it decreases, if the number goes down, then to some extent, it actually means that, in fact, when it comes to employment numbers in US companies, the private sector, and so on, we're seeing a trend toward weakness. If things are heading in a weaker direction, before the official data from the Department of Labor comes out, the Federal Reserve will of course look at this ADT data and at least use it as a reference. So what this means is, it basically tells everyone that the average weekly employment data is now down by 13,500 people, which means the job market is still relatively weak at the moment. As we've discussed before, as long as employment data remains weak, it will of course be favorable for the Federal Reserve to move toward cutting interest rates to support the economy. So what does this mean? Well, from a certain perspective or interpretation, it leans more toward being favorable for the Fed to cut interest rates, or at least it's something to consider. Now, regarding the officials, you don't really need to pay attention to Mester. Mester has always supported significant rate cuts. Basically, she says that if you don't cut rates, the unemployment rate will easily spike because the policy is too tight. Also, around Christmas time, you need to pay attention to this as well. This time, it's actually pretty important to see who will be the Fed's Santa Claus, because Treasury Secretary Bessent previously mentioned to everyone that Trump is expected to submit the candidate for the next Fed chair to Trump for a decision. So maybe the most suitable candidate, or who it will be announced before Christmas or before New Year's Day on January 1st. Right now, there are 5 candidates to choose from: Waller, Walsh, possibly Bowman, Hassett, and others. Now, looking at the market, the general consensus is that Hassett has a higher chance. And because of this rumor, people are leaning toward the idea that the future Fed will take a more dovish stance. But honestly, Hassett is currently serving as an economic advisor. Of course, his relationship with Trump is even closer, basically making him an ally, so it's pretty much all leaning toward Trump. If next year the Fed chair really does switch to Hassett, you can pretty much expect the entire Fed's operations to move in a dovish direction. Gradually, whether it's the board members, the chair, or even related positions, whether they have voting rights or not, will gradually be replaced. Little by little, Trump will definitely try to appoint as many dovish members as possible. So looking at next year, it seems pretty certain that the Fed system and its officials will be moving in a dovish, more accommodative direction. So whether Hassett gets elected or not, or whether someone else gets elected, I don't think it makes much of a difference. Why? Because all 5 of these candidates are basically going to listen to Trump. To put it bluntly, they're all puppets. Just Fed puppets. Trump's puppets, to be frank. So what do I think? Whether it's Waller, Bowman, or Hassett who gets elected, it's all the same. They're just going to carry out Trump's wishes. That's basically what Trump wants, so everyone should have a sense that it's going to be dovish. As for whether there will be a rate cut in December, I actually don't think it's all that important. Instead, I'm looking further ahead. Next year, for the whole year, the market currently expects there might be 2 to 3 rate cuts, probably about 2 to 3 times. And with the election coming up next year, monetary policy will probably lean more dovish. That's pretty much a given. So whether Hassett will be the one announced as the Santa Claus around Christmas, or if it's still Waller, I see it as pretty neutral either way. Because no matter who gets chosen, they're all dovish. Really, they're all dovish. Okay, so that's a little extra info about the Fed for everyone. Now, let's take a look at the 10-year Treasury yield, which has reached 4%. The terminal rate is holding steady at around 3.67 to 3.68%. The number of rate cuts is also at 0.8 times. So actually, over the past half month to about a month, you can see that whether it's the 10-year Treasury yield or the number of rate cuts, they've pretty much stayed right around that level, just holding steady there. So they've been holding steady at that level. To some extent, this kind of expectation is also telling everyone that, as of now, the chances of a rate cut or no rate cut in December look about the same, basically 50-50. Even though in the past few days, some dovish committee members have been more active in speaking out during this quiet period, can you really say there will be a rate cut in December? Honestly, I think right now it's still a toss-up, still 50-50, still 50-50. Of course, it's still the same old saying. Before the interest rate decision, before December 11th, you really need to pay special attention to the economic data that's released. For example, like yesterday, the PPI was announced, and most of the PPI figures were either in line with or below expectations. That means inflation has come down. So today, let's take a quick look at the job market. If the job market is still a bit weak, then just think about it. Inflation is down, and the job market is weak. Of course, that would be favorable for a rate cut in December. So it's better to analyze these economic data to figure out whether there's a chance for a rate cut in mid-December. I think that would be more objective, more neutral. Let me ask you, it seems like it's a 50-50 situation right now, and there hasn't been much change. It's leaning a bit toward the higher end of the range, leaning toward a rate cut in December. There's a chance for a rate cut, but it's not 100%, okay? As for the US dollar index, it's up slightly by 0.1%, staying around the 200-day and 20-day moving averages, just fluctuating there. Has there been any change regarding geopolitical risks? These two things, honestly, you just need to keep an eye on them, that's all, because there really hasn't been any major turning point. For example, Trump said he had a call with Xi Jinping. How did that call go? After the call, he said he hopes Xi Jinping can speed up and expand the purchase of agricultural products, and he said Xi Jinping basically agreed. Anyway, that's just Trump talking, so to some extent, I think next year, with the US-China trade war on hold for a year, it's basically to help Trump with the election. As for the situation in Ukraine, it's pretty interesting. The day before yesterday, they said they signed a 28-point peace agreement. Yesterday, they said the 28 points became 19. And today they didn't even mention how many points, just that Ukraine's defense secretary said, "Now, Ukraine and the US have reached a consensus on this peace agreement. There are still a few issues that can't be overcome yet, but they're not unsolvable. Further detailed discussions are needed." He didn't specify which ones. He didn't say. So he mentioned that among the 28 points, a few still need to be negotiated, but there has been progress. On November 27th, maybe Trump said that on November 27th, he hopes President Zelensky of Ukraine can sign this 28-point peace agreement, and then, really, both sides can move toward a ceasefire and actively work towards stopping the fighting. Whether it will succeed or not, there is a chance, a pretty good chance actually. At least there is progress being made right now. But as I said before, whether it's the 28 points or the 19 points, the content includes things like ceding territory and seeking peace. It also includes weakening Ukraine's military and banning NATO membership. There's still no consensus on these 3 points, and nothing has been made public. So is there a chance for successful talks on the 27th? I think so. But if these 3 issues are resolved, there's a real possibility for success. If not, the situation will just keep dragging on. I think there's little change in geopolitical risks now. It's still a stalemate. Crude oil prices are still trending down, bears haven't changed, and prices dropped 0.21%. As for the economy, as mentioned earlier, around 9:30, we can check together. Just follow the durable goods orders growth rate, that should be enough. Tomorrow, keep an eye on the Fed's Beige Book and also the European Central Bank's October policy minutes tomorrow night. Then, on Friday, well, after our group discussion tomorrow, the show will take a one-day break because Thanksgiving is a holiday, so the US stock market will be closed. After our group discussion tomorrow, the show will pause for a day. On Friday, the show returns as usual, even though there's no important data. Some might wonder, since it's Black Friday and the shopping season starts, why are we still doing a live broadcast? Yes, we're still going live. So this Friday, our live show continues as usual, just with a one-day break tomorrow. Just a reminder. As for earnings reports, tonight I'll briefly go over them with everyone. Good evening, M10. I'll also give you an update on the recently released earnings from Dell and HPQ, which is HP. These 2 earnings reports are kind of a mixed bag. One good, one bad. The good one is Dell. The bad one is HP. And right now, before the US stock market opens, these 2 companies are actually leading the way in terms of biggest gainers and losers. The top spot for biggest drop is probably HPQ, while the top spot for biggest gain is usually Dell. So what exactly is going on with their earnings reports? What kind of situation has come up? Why is Dell doing so well? If Dell's earnings report is really that good, is it actually a good time to buy now? where does it stand in terms of technical analysis? As for HP, even though its earnings report fell short of expectations, just how much did it miss? And what specific weaknesses should we be paying attention to? Is the current stock price a bargain? I'll explain all of this in a moment, including the stock price levels and more details about their earnings reports. As for after this Monday, next week we'll be heading into December, the last month of 2025. So what about the beginning of the month? Starting next week, there are still a few important companies that haven't released their earnings reports yet, including Marvel on December 3rd. Alright, Marvel's earnings report is related to these 6, which are special application chips. Companies like Marvel and Broadcom are the 2 major players in this area. So on December 3rd, next Wednesday, keep an eye on Marvel's earnings report. Then on December 4th, it's Salesforce, and on December 5th, it's HPE, HUYU Technology, which is related to Hewlett-Packard. All the earnings reports related to HUYU Technology will be released next week. On December 9th, Oracle's report is quite important. So one after another, next week's earnings reports are coming up, just giving everyone a heads up to keep an eye on them. Alright, as for what's happening on the ground, just a reminder for everyone about what to pay attention to. As for the answers, over the past few days, things have been a bit confusing and unclear, but there's a reason for that. It's because of Google's surprise move. The 3rd generation Google TPU, the Polo version, is really powerful and has received great reviews in the market. With such positive feedback, people are starting to worry that Google's TPU-related AI platform with such impressive computing power is not only self-developed, but also in collaboration with Broadcom. So does this mean that in the future, there won't be a need to rely on NVIDIA's chips? Also, this TPU is running really well. The Gemini 3, this version is pretty good and works well. Now, there are even rumors in the market that a lot of people are canceling their subscriptions and switching over to subscribe to Gemini. With this back and forth, as the competition heats up, is it really that easy to tell who's stronger or weaker? Can the difference be seen that quickly? Actually, it's not that easy to see the difference right away. The current market is really just going through an adjustment in atmosphere. Even though Gemini 3 has made rapid progress and surged ahead, it doesn't necessarily mean that the market has already written off OpenAI. Each has its own needs and its own market. Right now, the number 1 is still OpenAI's ChatGPT. Second place might be Gemini 3, and third could be Anthropic. These major AI platforms are all competing with each other, but they're also cooperating in some ways. With Google surging ahead, in the short term over the past week, Google's stock price has hit new highs repeatedly. Broadcom has risen too. When one rises, related stocks go up. As mentioned yesterday, Broadcom, AVGO, and Google have worked together on chips since 2016. So when Google performs well, the TPU chips are all designed and manufactured by Broadcom. So when Google does well, with Gemini 3 performing so impressively, of course Broadcom stock rises along with it. Now, with both Broadcom and Google going up, naturally people start to worry. What about NVIDIA? Will NVIDIA get knocked down? But there's no need to be overly concerned about NVIDIA. So what did NVIDIA say today? NVIDIA said, "Good evening, you're welcome. NVIDIA came out today to make a statement, to clarify things. They said, I'm happy for Google's success, but we will continue to provide Google with relevant GPU products. And they kept emphasizing that NVIDIA is the only company capable of running all AI models, and that their products can be used across all kinds of scenarios and platforms. They're a whole generation ahead of the industry, so Google's product might be from the previous generation, while NVIDIA's products are the very latest, the newest of the new. That's why they keep stressing this point to everyone. And of course, Google's being gracious about it. At this point, Google didn't jump in to kick them while they're down. Instead, Google said, he said that right now, in addition to their own self-developed TPU AI chips, there's also a strong demand for NVIDIA's GPUs. Both of these products are seeing significant growth. He also said that in the future, they will continue to use both to develop AI. In other words, they'll keep using their own self-developed TPU chips, and they'll also use NVIDIA's chips. Neither will be left out. Also, there's a media outlet called The Information, which we briefly mentioned to everyone yesterday. There are rumors that Meta is considering investing billions of dollars to buy Google's TPU chips. Okay, let's briefly explain this. Why is everyone concerned about whether Google's chips will replace NVIDIA's? Actually, it's pretty simple if we break it down. NVIDIA's chips are general-purpose chips. Okay, and Google's TPU chips, you can think of them as ASICs, which are application-specific chips. These chips, called TPUs, are specifically for AI training. Google worked with Broadcom to design and develop them together. So you can think of it like we talked about yesterday. Back in the mining days, in places like Rufang, Jufan, and Jingwashi, we said NVIDIA is like a power drill. It can dig any kind of ore, any kind of mine. Coal mines, gold mines, copper mines, it can dig them all. When you use your power drill, no matter what kind of rocks or walls you encounter, it's not a problem. That's why NVIDIA is unbeatable, dominating 90% of the market. Anytime you want to start mining, it's there. When it comes to mining pits, no matter what kind of ore you want to extract, you have to use a power drill to dig down, right? You definitely need heavy machinery. There's no way you could use one of those little gardening trowels to dig for coal or iron ore and then blast open a huge coal mine. That's just impossible. You can't do it. Time wouldn't allow you to just keep digging and digging for hundreds of years without finishing. So no matter what kind of ore you're mining, you need this universal chip from Greyhammer. It's like a power drill, okay? And because it's like a power drill, it's universal. So once you've blasted open the mine, dug it out, and finished the initial work, if you really want to go in and carefully mine for diamonds, whether you're picking out gold, sifting for gold dust, or chipping away at a coal mine, at this point, you can't just use a power drill to dig, because for some minerals, if you use a power drill, it might actually damage the value of the mineral vein. It's not always suitable. Once the pit has been dug out, it might no longer be appropriate to use a Greyhammer power drill. You can't just keep digging wildly all the way down like that. So at this point, what do you need? You need specialized application tools like ASIC chips to go deeper, to do further training, to do forging. That's when companies like Broadcom, Marvell, and Google come in with their related TPU chips, which are used for AI, servers, networking, and other specialized chips. So you can imagine that after NVIDIA has finished digging out this mine and laying the foundation, when it comes to extracting the finer minerals for each different industry, that's when you need ASIC chips. So to put it simply, will these two major types of tools conflict with each other? They will, and they won't. Before you blast or dig the mine, you definitely need NVIDIA chips. But when it comes to the detailed extraction, what do you need? You need Google, Broadcom, Marvell, and other related chips. So each has its own market, and answering won't completely replace all these contexts. Broadcom and Marvell chips also won't completely replace NVIDIA. No, they won't. So following the logic of mining, that's how these tools are used. So today, when NVIDIA talks and Google responds, saying we'll use both types of chips, that's what they mean. Why does Google say they'll use both TPU and NVIDIA chips? Like I said earlier, whether you're mining a big, small, or specialized mine, you need different tools. Or if you want to use blasting methods, you still need both. Google has already answered everyone. They'll use both types of chips. So will this mean that NVIDIA's market share might drop a bit, maybe from 90% down to 80%? Is that possible? It could be, because after the initial mining is done, after blasting, you'll need these more specialized chips for detailed, specific functions to continue research and deeper training, and that's when you need to use Google's chips. Broadcom and Marvell, okay, so in the future, it's impossible for market share to always stay at 90%. That's just not possible, right? It will definitely go down. It's just a matter of how much it drops and how widely adopted things become. It's like yesterday when we talked about the little donkey and someone asked about this. It's the same logic as guns and bows and arrows on the African savanna. Back at the end of January, when we were describing this to everyone, we talked about the African savanna. Imagine you're a hunter on the African savanna. There are lions, elephants, tigers, leopards, as well as sparrows, wild boars, and small antelopes, things like that. That even includes sparrows and other birds. If you're just an ordinary hunter and all you want is to shoot a few wild boars or catch a few magpies to bring home and feed your family, do you really need a hunting rifle? You don't. Because, first of all, a hunting rifle is harder to use, more dangerous, and it costs more, just like how small and medium-sized businesses want to develop AI nowadays. They would have to buy a single NVIDIA GPU chip for $30,000 or $40,000 for research and development, but they don't need to, because if they did, the company would go under, so they can't afford it. Even if they could buy one, it wouldn't be enough. They couldn't operate with just one. Sometimes, to run a 45G model, you need 72 or 36 chips. If you go ahead and buy them, it'll cost tens of millions. You simply can't do it. So at this point, what might they do? They might look for some cloud server providers to rent their equipment, rent their computing power, and that would be enough. So in other words, on the African savanna, if all you need to do is hunt a few wild birds or shoot a few wild boars, just take a bow and arrow or a slingshot and that'll be enough. So at this point, what should you buy? Just get those chips like Deepika or the regular SQ chips from Broadcom, Marvell, or Google. Just look for those, and that'll be enough. But if today you really want to hunt lions, tigers, elephants, or clouded leopards, what then? You can't possibly use a bow and arrow for that. You also can't use a slingshot to take them down, because if you don't do it right, they'll turn on you. So what you need is a hunting rifle. At this point, you need a powerful hunting rifle. And that's where the big CSP players need to provide this kind of hunting rifle. So today, I just wanted to add this point for everyone. You can imagine taking something very complex and difficult, and we just use a very simple analogy, like say the coal mines in Rufang and Jufang compared to guns and bows on the African savanna. If you understand this, if you get what I mean, you'll realize that these are actually two different markets, two different tools. They won't replace each other because each has its own needs, each has its own demands. So whether it's Baidu or Google, the reason they're coming out to clarify things today is to tell everyone that the whole AI savanna is still thriving right now. There's no need to worry too much about whether Baidu will be knocked out or whether Google will suddenly surge ahead and go from second place to first. That's unlikely because each has its own position. It's just that the direction of the market winds, where they're blowing, where they're heading, might shift from time to time. Sometimes it might swing back this way, and then occasionally it starts leaning more toward Google again. That's basically the idea. All right, good night, and also good evening. Let's take some time to chat with everyone about these related topics. As for Nvidia stock price, of course, it's been affected by Google's seemingly rapid progress, so it's facing more short-term pressure. Yesterday, it continued to fall by 2.6%. It's still hovering below the quarterly moving average, so in the short term, it's more in a consolidation and volatile phase. But if you ask whether it's entering a long-term downtrend, that's not the case. If it were truly in a long-term downtrend, then honestly, all AI companies would be doomed. Because after all, they're the biggest supplier of mining tools out there. If you want to mine for gold, coal, copper, or whatever, all the companies and enterprises have to go to Nvidia to buy the equipment, to buy these tools. So yeah, doesn't matter if anyone actually makes money in the AI market. For Nvidia, it doesn't matter at all. Everyone has to buy their chips. That's the idea here. Like back in the heyday of Jufin, when everyone was mining coal and gold and the place was packed, who made the most money? Sometimes, maybe it's the owners of certain mines who make a lot of money, but who really makes the most? Who has the easiest time? No matter who you are or what kind of mining you do, they're always making money. It's the people selling shovels. The shovel sellers make the most, and Nvidia is basically selling the shovels. If their stock price turns bearish long term, all the other AI companies are done too. Because it's the top tier supplier, if it goes down, the whole ASM crashes, and that's the only way it would. That's the idea. In the short term, just watch it. Right now, it's fluctuating and consolidating around the main shipping line. Let it fluctuate and finish consolidating. Maybe after the consolidation and the fundamentals of the chips are corrected, there will still be a chance for it to reach new heights. It's just that in the short term, the market is full of noise and concerns, like the huge capital expenditures. People worry about things being hidden, such as expanding production capacity, excessive capital spending, possibly insufficient debt repayment ability, or cash flow issues. For example, Oracle and Meta, and now Google and Broadcom are surging as well. So with these negative factors coming from both sides, that's the current situation. You'll notice that whether it's Nvidia, AMD, or SNCI, the stock performance of these companies has been more volatile, weaker, and relatively less resilient against declines. So I think this is just a short-term issue. Just treat it as a temporary influence. But in the long run, I believe Nvidia and AMD still have a lot of market potential. A lot of market potential. The movie God of Gamblers 2, set in Shanghai, is actually on tonight, and it's a pretty good film. Of course, there are so many classic scenes from Stephen Chow's movies, so many memorable moments. Sometimes, if I haven't watched them in a long time, I remember back when you could just turn on Channel 4 and catch those movies. Was it Longshang Movie Channel or Dongshang Channel? They played these movies a lot. God of Gamblers, Casino Tycoon with Andy Lau, and God of Gamblers 2 with Stephen Chow. Many people enjoyed those. There was also Da Jun and others. This is the Q&A part. Also, today there's some relatively positive news. Okay, that's 6 per yes, right? July 5th, 85th? Okay, you're welcome. All right, okay, good. Simple and easy to understand. Okay, as long as you can understand, that's good. Okay, so what's the other piece of positive news? Let's talk about the double A part. One is not ASOS, and with Acer, we're talking about the US stock market. One is called Alphabet, and the other is Apple. So what kind of positive news has come out for these two companies? Of course, Google, which is what we're talking about. Google has recently had some buzz about Gemini being pretty good, right? And the other piece of good news is about Apple. I'll tell you what the positive news is for Apple in a bit. For now, let's take a look at the economic data. So what should we do about Nvidia stock? Amy, Nvidia stock is even weaker in the short term, right? It's like, think about it. If the father is out there, with all this uncertainty and a lot of negative news lately, he's in a hurry to clear things up, trying to clarify everywhere. Remember before Michael Burry was talking about shorting Nvidia, and then a few days ago, news came out that Nvidia responded directly. Their CFO clarified, saying, "Our financial reports are fine. Our operations and financing are in good shape." People worry about this so-called AI perpetual motion machine. Who's buying whom, who's investing in whom, this endless cycle. For example, Nvidia invests in Oracle, Oracle invests back in Nvidia, and nearly $600 to $700 billion circulate in this loop. But they said, there's no problem with this cycle. For example, regarding making money, the CFO clarified this. The CFO addressed it directly. Nvidia isn't in a precarious situation now, but there are many negative rumors. So there will be times when they face storms and rough weather. So when the father is out fishing and making money, the pressure is huge. At times like this, how could he possibly take care of his kids? He just can't. The father has recently been beaten black and blue, so to speak. Now his child is CRWV, that is COVID or COVID. Basically, Nvidia invested in them. I think it was close to, how much was it? About $3 billion or so. I can't quite remember the exact amount. Anyway, about 90% of Nvidia's investment portfolio is invested in them, and Nvidia holds about 7 or 8%, maybe around 6 or 7% of COVID shares. I forgot the exact numbers, and those figures might fluctuate. If the father isn't doing well, the son suffers too. That's the idea. That's why recently, COVID, the child of Nvidia, has dropped even more. If you check the chart, CRW keeps going down. That's the situation. Nvidia is running itself ragged. That's the idea. Now, let's look at the data. First, the numbers. The data we mentioned is about people showing up for work. The latest U.S. unemployment claims just came out, 216,000. This is lower than expected and lower than before, so the job market is still okay. It's not collapsing, it's just steady, but because it's lukewarm. Now, let's also look at the number of people continuing to claim unemployment benefits. That number has dropped to 1.96 million, which is lower than expected and also lower than the previous figure. This data is pretty interesting too, because it suggests that, at least for this week, or rather it's an assessment of last week, or at least the most recent numbers for initial and continuing unemployment claims. For now, things are still okay. It's not as bad as everyone imagines, not that bad. Of course, because of this, the desire or likelihood for a rate cut has dropped again, probably dropped further. Like we just said, if the data that was just released had been above 225,000 or even above 220,000, then people might have thought, wow, the job market is relatively weak, and that would increase the chances of a rate cut, right? Because the Fed might want to step in to help. The Fed might step in to help the job market, but for now, employment numbers and demand are still okay, not as bad as expected. This means the chance of a rate cut has dropped again today. Each time new data comes out, the market reacts, and that's what we're seeing. Also, the monthly rate for durable goods orders was 0.5%, higher than the expected 0.3%. This shows there aren't major concerns about the economy. It's still fairly strong, or at least stable. With the data released at 9:30, we can say the job market is still relatively stable. But it's not bad enough to make the Fed more likely to cut rates. That's about it. On the other hand, the economy is still doing pretty well, mainly because the durable goods orders monthly rate also came in at 0.5, which is higher than the market expected. So overall, I think for the US stock market today, the outlook is pretty neutral. It's pretty neutral because there's a mix of good and bad news, so it balances out. With this kind of neutral sentiment, if you look at US stock futures before the market opens, they're just slightly up or down, like 0.2 or 0.3%. That's the kind of fluctuation we're seeing right now, so the impact isn't really significant. All right, so that's a quick update on the initial jobless claims and durable goods orders. Just wanted to give everyone a brief supplement with the latest data that was just released at 9:30. Okay, now let's move on and take a look at something else. So Counterpoint, this organization did a survey and found that the iPhone 17's growth, well, it's selling like crazy, really well. The growth of the iPhone 11 has given Apple a chance, he said, to surpass Samsung's growth rate this year. It's estimated that in 2025, iPhone shipments will increase by 10%. That would put Apple ahead of Samsung by 4.6%. And as for the overall smartphone market, it's expected to grow by 3.3% in 2025. And Apple's global market share could potentially reach 19.4%, reclaiming the #1 spot worldwide. Of course, this is based on an internal survey by Counterpoint. As for whether Apple will really shine because of the iPhone 17, well, it's true that the iPhone 11 sold pretty well, especially since the Pro and other upgraded versions have all been doing quite well. The iPhone C sold really well, but will Apple be able to reclaim the #1 spot in market share? I think we still need to wait and see, because even though sales are good, that doesn't necessarily mean they'll take the top spot in market share. It's not always directly proportional, because Samsung isn't just some plastic brand or a paper tiger either. So just because the iPhone X sold really well doesn't mean Samsung did terribly. As for the #1 spot globally, I think, it's not necessarily Samsung either. Basically, it's just Apple and Samsung taking turns at the top. Now, what I want to tell everyone is why the so-called AA is so important. At this stage, with the international stock market fluctuating at high levels and pulling back to the quarterly moving average for consolidation, why is AA especially important? What about Google? Recently, thanks to the hype around Gemini and the TPU, Google has stayed strong and kept hitting new highs, so its performance has been good. I remember its market cap is already among the top 3 globally, which is impressive. For Apple, today's positive news helped a bit, with Apple reaching new highs and supporting the market. Like yesterday, Apple surged above $280, hitting a record high, still very strong. So why do we say these two stocks are important for supporting the market? Take Apple, for example. In the Dow Jones Index, Apple's weight is about 3%. Alright, so it only makes up 10% in the Nasdaq and 6% in the S&P 500. Honestly, that's not a small share. They're both among the top 5, right? Now, you might wonder why Apple only accounts for 3% in the Dow Jones. That's because the Dow is price-weighted. What does price-weighted mean? In the Dow's 30 components, the higher a stock's price, the greater its weight. The lower the price, the smaller its weight. That's because the Dow uses price to calculate its index. For the Nasdaq and S&P, weighting is based on market capitalization. The higher the market cap, the greater the weight. What's Apple's market cap? If I recall, it's in the top 3, already over $4 trillion, while Microsoft is about $5 trillion. These are rough numbers. So about 4 trillion, and Microsoft is about 4 trillion too. The higher the market cap, the higher its weighting. That's why in the Nasdaq, Apple holds a 10% weight, and in the S&P, it's about 6%, which is higher than in the Dow Jones. That's the reason. No matter which one it is, whether it's the Dow, Nasdaq, or S&P, they all have Apple's presence. So Apple becomes the key stock that can easily move the market. In other words, if the authorities or the government want to support the market so it doesn't perform too poorly, doesn't fall below the quarterly moving average, and then suddenly drop all the way to the annual or 200-day moving average, who do they support? They support these high-weighted stocks like Nvidia, Microsoft, Amazon, and especially Apple, because all of them have solid fundamentals. So that's the reason. If they push Apple up, basically the Dow, Nasdaq, and S&P indexes won't look too bad. You can imagine it. Apple is to the US what TSMC is to Taiwan. It's that kind of feeling. When TSMC moves, it affects the whole market, right? That's how it is. TSMC now accounts for about 42 or 43% of the Taiwan stock market's weight, around 42%. So as long as the National Stabilization Fund gives it a little boost, if TSMC goes up by $5 or $10, the Taiwan stock market will rise by 100 points. That's the idea. The index is being propped up and looks great, whether it's 27, 28, or 29,000 points. As long as they keep nudging it up and TSMC keeps climbing, it doesn't matter how much other small and mid-sized companies drop. They're ignored. Just boosting TSMC, which is 43% of the market, is enough to support the index. So it's just like in the US. As long as they keep pushing up Microsoft and Apple, the index will stay up there. But keeping the index up like that just makes everyone think the index looks great, that it hasn't crashed. Still, it can easily mislead a lot of investors. They lose their sense of risk because Apple is going up, Google is going up, or maybe TSMC and MediaTek are rising, or even Fubon Financial, Delta Electronics, and even Hanhai are climbing. If these stocks are going up, you might unconsciously think the whole market is doing great. But what you don't realize is that, in reality, a lot of small and mid-cap stocks are hitting new lows, and many shipping stocks are also hitting new lows. This is something that can easily make people let their guard down, so you still need to take a closer look at the stocks you're holding. Now, let's look directly at this. Take Apple, for example. Its market share, the iPhone 11 is selling well, so its stock price is still following the monthly and seasonal moving averages, showing a bullish trend. So if you have these two A-class stocks in your portfolio, basically you don't need to rush to sell them, because these two stocks, along with Apple, are currently the only two strong ones in the tech sector, and they're also important indicators supporting the market. So as long as as these two stocks don't collapse, basically, you're fine. The overall market probably won't stop either. That's the general idea. So yesterday, it still hit a new high with a slight increase of 0.38%. Now, to add a final note about Dell and HP stock prices and their current positions, as for fundamentals, Dell's revenue in the third quarter reached $27 billion, an 11% year-over-year growth, which was below expectations, but its EPS and areas like infrastructure, servers, and network equipment all outperformed, even setting a new record for the same period. Their performance was impressive. For the fourth quarter, revenue is expected to reach between $31 and $32 billion, a 30% year-over-year increase. EPS is expected to hit $3.50, also beating expectations. Both full-year revenue and profits have been revised upward. Everything has been revised up. Why the upward revision? Because AI sales have been strong, and 5G and other segments have seen significant growth. With such strong sales, the financial reports are impressive. However, technically, the recent stock price has been under quite a bit of pressure. Yesterday, it even dropped by 1.02%. Recently, it just corrected down to the 200-day moving average. If you look at the right side here, you can get a sense of the price, roughly where it is. For now, the 200-day moving average is still holding up. Today, there's still a chance it can continue to hold above the 200-day moving average. So as long as it doesn't fall below the 200-day moving average, there's no need to worry too much. It's just that, it already went up from around 120 or 130 all the way to 170. And in the short term, starting from the end of October or the beginning of November, it dropped from 170 to 120. That's the idea. In the short term, this correction brought it to the 200-day moving average. So if it reaches that level, the market doesn't need to panic sell, because usually a rebound happens here. Also, its financial reports for the third and fourth quarters and the full year are coming up. They're all pretty good, all better than expected, and they've even raised their full year forecasts. So overall, I think for Dell, its stock price performance today should have a good chance of moving in a better direction. Now, as for the other company, HP is relatively weaker, because its third quarter revenue came in at $14.6 billion, which is a 4% year-over-year growth and better than expected, and the EPS also beat expectations. However, they said that the EPS forecast for the fourth quarter and the full-year profit are both below expectations. Why is that? He said it's because of things like US trade regulations and so on, which have led to a lot of extra costs. He also mentioned that over the next 3 years, from 2025 to 2028, they plan to lay off 4,000 to 6,000 people. 4,000 to 6,000 people losing their jobs might have to collect unemployment benefits, which will really impact a lot of families. In the next 3 years, high-tech is going to be intense. High-tech salaries are very high, but the pressure is also huge. You all know, like some of my friends before, they worked at, I myself used to work at Foxconn, and some friends are at MediaTek or other companies. For those working as engineers, it's really nonstop, day and night. Same goes for TSMC. It's nonstop. The pay is high, but sometimes you have to work overtime. Sometimes you have to handle certain projects, and when you work overtime or even on weekends, you can't rest. Sometimes, even when you get home at night to sleep, you still have to be on call. If the boss or something happens, like your server has a bug, you're on call. So if you get called at 3 in the morning, you have to go deal with it. That's why they're under a lot of pressure. Some are doing R&D, and they're always on call, so the mental stress is really, really intense. You'll wake up and go to work, come home after work and just sleep. Then you wake up and go to work again. Basically, that's all there is to it. There's not much leisure or entertainment in between, you just work. But the only upside is that you make a ton of money, more than you can spend. Stock options, dividends, bonuses, performance incentives, you name it. There's a whole bunch. Annual salaries start at 3 to 5 million, even up to 10 million, and a lot of people are like that. But in exchange, you're trading your health and your energy for it. They're under a lot of pressure. So in these kinds of high-tech companies, if your performance isn't up to par, or if the company is considering costs and decides to do layoffs or restructuring, sometimes when they cut the whole department, and it's just gone. The whole department, the entire project team, sometimes even the whole department in Gizo, whether it's 5, 10, or 20 people, gets eliminated. That's how it works. They just decide they don't want this department. If it's the AI department, another R&D team, or a marketing department they no longer need, when they cut, it's not just a layoff. It's the whole department gone, wiped out and rebuilt. When a department is cut, dozens of families are suddenly out of work, losing their jobs. Speaking of HP, they said that in order to cut costs over the next 3 years, they plan to lay off 4,000 to 6,000 people. 4,000 to 6,000 people. I actually have friends who work at HP. Luckily, one of them is a senior, very high-level executive, so he probably won't be affected. But from what I've heard them say before, because recently HP has been laying people off, right? Some layoffs. Actually, it's not just in the next 3 years. They've already been laying people off before that too. These senior executives, sometimes in order to comply with company policy, when they have to carry out layoffs, they're actually under a lot of pressure too. For example, if their higher ups give them an order and say, your department has 2 people, you need to cut one. If you have 2 people and need to cut one, who do you choose? You have to make the call and cut half, right? So who do you pick? This one's good, that one's good. You haven't had conflicts with either. Both subordinates have their own strengths and are pretty good. Maybe their performance is similar or one is a bit higher or lower, but your boss just told you your department has 2 people, you have to cut one. That means you must lay off 50%. So what do? You end up feeling conflicted. So if you lay him off, is that the right thing to do? Or if you have to let him go, you end up being the bad guy, the one who has to do the dirty work. There's just no way around it. That's the kind of pressure senior managers face. Of course, lower level employees have their own survival pressures too. I think in the end, we're all just trying to make a living. The pressure's really intense, you know? Then Jimmy's mom said, looks like the teacher's better at giving birth to me. For me, honestly, one of the main reasons I would ever consider leaving Foxconn is because of health reasons. At Foxconn, to be honest, money is never a problem. There's a lot of money there, annual salaries in the millions, so money isn't the issue. But it's your health. You have to figure out how to take care of your own health. If you can't manage your health, or can't handle the stress, or if you can't find a way to release it, you'll get sick really easily. If your health is easily affected, you know, back then, a big reason I left Foxconn was because the pressure was just too much. My body couldn't take it, I couldn't hold on, so I had to go back to the finance industry. That's the idea. Every time I give a talk, I share why I left Foxconn and what happened. My weight would fluctuate a lot, and I'd talk about it with people. In high tech, pressure is always intense. For HP, yesterday it dipped by 0.25%, but compared to Dell, their stock prices tell different stories. Dell stock is still above the 200-day moving average. But as for HP, its stock is right at the 200-day moving average, that brown line. Not just the 200-day, but also the 20-day and 50-day moving averages are all pressing down on it. There's a lot of pressure today, and it might even break to new lows. It's possible. So in the short term, it's still relatively weak, so keep an eye on it. Over the next 3 years, they're planning to lay off 4,000 to 6,000 employees, which I think is a lot of pressure. All the employees working there are really having a tough time. All right, any companies before the market opens? Top gainer is Autodesk, up 7%. They make software. Next is Internet Applications, up 4.78%. Dell Technologies and Oracle, as mentioned, are both up about 2 to 4% pre-market. Robinhood and Google are also up around 2%. HPE, Hewlett-Packard Enterprise, is up 1.5% before the market opens. On the downside, Workday is down 5.8% pre-market, mainly due to poor earnings. HPQ, HP Inc. is also down 4.8% before the market opens. Dell's also down 4.75%. This is closely related to earnings reports, so today's stock moves are basically tied to earnings releases. Overall, things are still okay, it's just a reaction to earnings. The strongest companies remain the same, and AI stocks are still leading. As for the weaker stocks, looking at it right now, the pre-market weak stocks today don't really have a huge impact on the major indices for the whole tech sector. The companies that are up, like Oracle, Alphabet, and so on, might still have some effect on the market. So we're still seeing this idea of small gains and small losses. For now, that hasn't changed. So what about the Dow Jones Index? It's doing pretty well, up by 1.43%. It's climbed back above the quarterly moving average and is slowly trying to challenge the monthly moving average. Actually, in the short term, it's also consolidating around the monthly moving average, so you shouldn't expect it to suddenly surge or hit new highs. For now, it's just witnessing some high-level fluctuations. High-level fluctuations mean individual stocks are showing high volatility, so the index reflects the performance. Some are strong, like Google and Apple, both doing well. Others are consolidating, like Tesla, which is moving sideways. Amazon is doing fairly well, hovering near a key neckline. Weaker ones, after a steep drop, might rebound a bit, maybe like Meta. Some occasionally rise above the quarterly moving average, but then fall back, like Nvidia. This is the current trend, so the ups and downs of individual stocks differ quite a bit. The Philadelphia Semiconductor Index rose 0.16% yesterday. Both its monthly and quarterly moving averages are trending down, with the quarterly average weaker than the Dow Jones. The index did not break above the quarterly average. The Magnificent 7 index is strong, above both moving averages. If you're unsure which stocks to buy, consider sector ETFs. More than enough, so keep investing. Recently, the Magnificent 7 have shown divergence between bulls and bears. Whether you look at the index or individual stocks, this divergence usually leads to a more sideways consolidating trend, not a bearish direction. So again, just a reminder for everyone. Tomorrow's Thanksgiving, so the market will be closed. There won't be a group evening event tomorrow because of the holiday, but Friday's show will go on as usual, and we'll see everyone then. Alright, that's all for your group's Good Night Update, bringing you the latest news before the US stock market opens. When class is over, remember to like, subscribe, and share for us. Finally, wishing everyone smooth trading, and we'll see you tomorrow. Wait, no, we'll see you on Friday. Bye-bye!
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.